Hi, this is Brandon Bischoff with Canterbury Investment Management, bringing you this week's Canterbury Market Update for the week of September the 2nd, 2019. And so looking at the S&P 500, we are still in a transitional market state 6. We've been there for about 20 trading days since August the 5th, and we initially saw that volatility spike that since caused us to kind of enter into this trading range. If we actually look at the Russell 2000, it's actually in a bearish market state 12. The Russell 2000 measures small cap stocks as opposed to the S&P, which measures large cap stocks. So small cap stocks are actually behaving a lot more bearish right now. The Canterbury Volatility Index measures CDI 85. And so this transitional market that we're seeing has been a lot more volatile. We're seeing a lot more outlier days, beyond 1%, beyond 1.5%. And so transitional markets, they're unpredictable. A lot go back to being bullish, but some could break down and become bearish. And because of that, risk management is really crucial here. And so if you look at the S&P 500, we are in a trading range. So we have overhead resistance at 2940, and we have support at about 2820. So the market's been fluctuating within that range, coming down, touching support, bouncing off, hitting resistance, and going down again. So most recently, we've actually touched resistance on Friday, and then today it's sort of come back off of that resistance a little bit. As we're doing this video about 3 o'clock, the market's off about 0.75%. And so moving on, if we look at the Russell 2000 compared to the S&P 500, rather than being in a trading range, its trading range is sloping downward. So the Russell 2000, which is behaving more bearish, is putting in a series of lower highs and lower lows. And then looking at S&P 500 stocks, our Canterbury Analytics group ran security states on each one of the 500 stocks in the S&P 500 and found that 158 stocks were bullish or in a bullish market state, 124 stocks were transitional, and 218 were actually bearish. And so only 3 sectors had a majority of positions that were bullish, and those were consumer staples, utilities, and real estate. The rest either had a majority transitional stocks or actually bearish stocks. And one thing to point out about healthcare, which is kind of interesting, healthcare is being dragged down by pharmaceuticals, but it actually has a sub-industry within it, medical devices, which has performed very well and been, bullish over the previous period here. And looking at the portfolio thermostat, we aim to maintain efficiency through all market environments, whether bullish, bearish, or transitional like we're seeing now. And so the portfolio thermostat has actually taken steps to help stabilize the portfolio, through these up and down swings. And so it's actually taken some positions in inverse positions that help increase our benefit of diversification and reduce our volatility. Because like I mentioned earlier, risk management is really crucial here. Whether the market goes up or breaks down below, we want to be able to manage the risk within our portfolio. And so adding some of those more negatively correlated positions to the market allows us to do so, kind of prevent some of those outlier days we're seeing. So bottom line, we're still in a transitional market. We're trading within that trading range, but small caps are performing, much worse. And there's a lot of stocks in the S&P 500 that have negative characteristics. Consumer staples, utilities, and real estate have a majority of stocks that actually have bullish characteristics. But the portfolio thermostat will continue to make some adjustments to maintain an efficient portfolio through whatever kind of environment comes next, whether it's bullish or bearish. Thank you and have a great week.